Hey everyone, welcome back to POA for You. My name is Leroy and today we're going to cover non-current assets. This is applicable for N-level students as well as O-level students, and I hope you guys will really find it useful. Before we start, if you know of a friend who could benefit from this video, please share it with them. Free resource for everybody. Alright, let's get right into it. Oh, one thing I forgot to mention just before we start on this session, I've included a content summary and the timestamps on different topics that will be covered in this video just right after this. So take a look at that and then you can scroll in and out or right to that section where you need the most help. Okay, so before I get into the theories and stuff like that, let's look at some exam questions. We see that in paper 2 question 1 of whether it's O-level or N-level exams, you guys will always be asked to calculate something on a straight line basis or depreciation on a straight line basis or reducing balance method. And this is definitely going to come out every year. So you've got to make sure you know what the concepts are, what the implications are to the financial statement of financial performance or statement of financial position, etc. They would also ask you to calculate journal entries. So they could be standalone questions, right? Like this, whereby it's specific on non-current assets, and they ask you to calculate, to work out the journal entries when you purchase a non-current asset, or to prepare a depreciation and accumulated depreciation account across different years. And this is for N levels as well. O levels, they're asking the same thing. O level students, they will you could also be asked to calculate the profit or loss or gain or loss on the sale of motor vehicles or other non-current assets. So these are the kind of questions that you would be possibly get when you are in your exams, and hopefully my session would help you answer them. Let's look at what I have next. What are non-current assets? So non-current assets, you must think the big stuff, right? It's the motor vehicles that you buy, like the delivery van, buildings and equipments, and even office equipments, right? So these, when you think about them, they are usually expensive, more expensive than, let's say, stationery or a piece of pen or something like that, and they usually last for a long time. So when you buy a motor vehicle, a delivery van, it could last you for maybe 5-10 years at least, right? And if you have a building, if you buy a building for your business, that could last you 10-20-30 years, right? So the key thing is, how do I then apportion this cost of purchase across my different years of my income statement or my statement of financial performance? That's where the concept of depreciation comes in, and let's take a look at what it is now. Depreciation, the first method is straight line method, and that's the simplest method, most straightforward. And let's work this through in an example that I have here. So if you buy a delivery van for $50,000 and you are told that, hey, this delivery van would last for 10 years, and typically in Singapore that's the case as well, because you have a certificate, you have to buy a certificate of entitlement for 10 years as well, right? And that's tagged to the delivery van. And if we don't depreciate, we will find ourselves in a situation where this 50,000 will be charged to the first year of life of this delivery van, and subsequently in the second to the 10th year, it will be zero, right? The charge would be zero. And the implication of that is, if you're going to charge everything to 1 year, then in your statement of financial performance, where you have your sales and gross profits and stuff like that, in your other expense portion, if you don't do any depreciation, then you will have a motor vehicle cost charged in the first year of 50,000. And then in the subsequent second to 10th year, you will have nothing. Now, if you look at this profits for the year would then be very odd in the first year, extremely low in the first year, and unusually high in the second to 10th year. So, you are not able to, for comparative purposes, it looks very odd, right? And makes almost the financial statements not comparable across years. Now, the other reason why this may not be good is because if you don't charge depreciation, then you are saying that, hey, for the first year, my delivery van has helped me earn all these revenues, and I'm going to charge all the delivery van costs here, but in the subsequent years, all these revenues that it has helped me earn, I'm not going to charge it anything. So from a matching principle point of view, where you're trying to match all the expenses that it takes to earn you these revenues, it's very imbalanced in this scenario. Now that's why we have depreciation, and under the straight line method, you would have that depreciation across 10 years, since it's 10-year useful life, sharing 1/10 of the cost each across the 10 years. Now what would happen in this scenario is your statement of financial performance would then have depreciation in the first year of 5,000 here instead of 50, and subsequent years 2 to 10 would be 5,000 as well. And then your profits, if everything else is the same, would be more balanced. So you look at this statement of financial performance versus this one looks a bit more fluctuating, right? This one is a bit more stable, a bit more comparable, right? Of course, this example, everything else is the same, which is not realistic, but you get the gist of the concept. Okay, now after knowing now what depreciation is, it's basically sharing the cost of the fixed asset or the non-current asset across its useful years or useful life in a way that reflects the usage of the asset to earn the revenues, to help earn the revenues. Okay, you have to understand the concept of accumulated depreciation too. Like the name suggests, it's an accumulation of depreciation that has been charged. So for first year, it's the same as the depreciation charge for that year, because there's year 0, you don't have any depreciation before that. But the second year, the accumulated depreciation would be the depreciation charge for the current year, the year 2, as well as the depreciation charge for year 1. Third year, it would be the depreciation charge for year 3, as well as the depreciation charge in the years before that, which is year 2 and 1. So it's 15,000, and then it goes on, etc., until the 10th year. The 10th year, you would see that under the straight line method, the depreciation would always be equal to the cost of the asset if the asset doesn't have a residual value, right? But in this case, we just assume that it doesn't straightforward, so it's always the cost of the asset. Now I'm going to introduce the next concept to you. It's called net book value. Now, net book value is simply the cost of the asset, 50,000, minus the accumulated depreciation for the asset. So for first year, it's 50,000 minus 5, that's why it's 45. Second year, 50,000 minus 10, that's why it's 40, etc., etc. And you would see that the net book value will be 0 at the end of the 10 year, which also kind of matches that whole thing that the asset life has ended after 10 years, and therefore the asset doesn't have any value. Right? So that is the kind of concept that you should be thinking about. Now, in this case, example here, could you tell me what the depreciation policy is? Think about it. Pause your video. Pause the video if you need to. I'm going to share with you the answer now. 10% per annum using straight line method. And that's the kind of things that your examiners would sometimes ask you to calculate the depreciation based on 10% per annum using straight line method. And this is exactly what they're saying, because 10% is it means 10% of the asset value would be shaved off every year. And like this example, you see 10% is actually shaved off every year. And from the percentage, you can roughly kind of gauge the useful life. 10% is 10 years, 20% is 5 years. It's kind of a mathematical thing that would indicate the useful life for the asset for us. And the formula, very simple, right? So cost times depreciation rate of 10% times the cost, 50,000, is 5,000. That's it. Okay, next, reducing balance method. This is more complicated, but not so difficult. Right, so let's see. Reducing balance is usually used for assets that useful life, that maybe throughout the useful life, it will contribute a bit more value to the business in the beginning of its years than the later part of its years, right? So things like computers and technology stuff, right? Because later part of its years, maybe new technologies introduced, it gets obsolete and stuff like that. So I'll share with you using this example. 10,000 you paid, all right? So great. And then they tell you 3 years useful life, and I want to depreciate it using 50% reducing balance method. Now, what is the depreciation? Can you calculate this for me? Over 3 years. Pause the video and see what you get. I'm going to show you the answer now. So this is what I got: 5,000, 2005, 1,250. If you didn't get this answer, I will share with you how I got to this conclusion, and then you can compare your understanding with mine. Okay, so I'll show you these other things like accumulated depreciation, net book value. I've gone through them earlier. So the same concept as straight line and reducing balance for accumulated and net book value. So first year, 5,000, the depreciation rate is 50% on reducing balance method. 50% will be multiplied by the net book value of the asset. Right? In the first year, the net book value of the asset is equals to the cost because there's no depreciation before that. So cost minus 0 depreciation equals to the net book value, which is equals to the cost. So it's 50% times 10,000 is 5,000. Then second year, the net book value would be 10,000 minus 5,000, which is 5,000, right? That's the net book value. The net book value at the end of the first year would be the net book value in the beginning of the second year. So you take 50% times 5,000 will be 2,005. And then the accumulated depreciation will be higher at 7,005. Net book value will be 10,000 minus 7,005, which is 2,005. Which means that the ending net book value of the asset at year 2 is 2005, and which makes the beginning net book value of the asset at year 3 to be 2005. You multiply that in year 3 by 50%, which is then year 3 depreciation will be 1,250, and so on and so forth. You will see at the end of the time, the net book value would never be 0. And if the asset is thrown away or sold, or let's say disposed, just thrown away, then this $1,250 of net book value remaining will be then charged to the income statement or the statement of financial performance as a loss on sale of non-current asset. Okay. All right, formula. I've put down the formula here. I've explained it. So take a look at it and see. If you don't understand, send me a note. All right, let's look at the journal entries, right? Because these are quite important and they have been tested as well. Purchase of non-current asset, straightforward. You buy an asset goes up, so you debit motor vehicles and you credit. If you bought it through a check, then it's credit cash at bank and or credit other liabilities. Take a look at the rationale here. I've got a lesson on journal entries, so if you don't understand this, go and look at that lesson or send me a note as well. Now, yearly depreciation charge on non-current asset. This is key. You need to remember that. This one, it's debit depreciation, credit accumulated depreciation. Depreciation is always an expense. So if an expense goes up, you debit it because it's a debit in nature. Accumulated depreciation is a contra asset type of account. So asset is debit nature and contra asset is the opposite. So it's credit in nature. So whenever you charge a new depreciation to your financial statements, then your expenses will go up and this accumulated depreciation will go up as well. Debit depreciation and credit accumulated depreciation respectively. Now, frequently tested concept. I told you paper 2 question 1, you have to understand these journals. These are the journals that will underpin the correct answer to your depreciation adjustments in paper 2 question 1, and there are standalone questions as well, like I showed you earlier. So because there are standalone questions, I will show you how the journals would then translate into ledgers like this, because you would be expected to compute what the depreciation and accumulated depreciation account look like over several years, mostly 2 years. So like this, I'll show you with this example. Motor vehicle cost 50%, straight line 10% per annum, let's assume that, and we want to do it over 2 years, the depreciation and accumulated depreciation account. This is the underlying journal entry you got to remember. How I got 5,000, 10% times 5,000, 50,000, straightforward. Now let's take a look what happens across those 2 years, all right? Okay, so with the base journal entry of debit depreciation, credit accumulated depreciation to account for any depreciation charge for the year, let's see how these would go into the ledger accounts respectively. Depreciation for motor vehicle account, right? The format is standard and it's date, particulars, debit, credit, balance, right? It will be charged since you're debiting the depreciation for motor vehicle account. So in the depreciation for motor vehicle account on the debit side, you will see this 5,000 coming in here. and in the particulars you would then put the corresponding credit entry. It's always the other entry. The particulars is always going to be the other entry, the name of the other entry, right? So in this case, accumulated depreciation. The date is always going to be the last day of the year, the financial year. So in this case, financial year ends in 31st December, so that's what it is. Accumulated depreciation, it's going down to the accumulated depreciation motor vehicles since you credit this account. So on the credit side, that's where the number falls, and the particulars is always what's written on the other side of the journal entry. Okay, now what happens after this? If there's no activities at the end of the year, then it will go into this will close into the profit and loss account, so that the balance will be zero out. And this 5,000 here would flow into the statement of financial performance for you to work out your profit or loss for the year. Okay, that's the big picture of where this would go eventually. Now, of course, this profit for the year then will go into your balance sheet or the statement of financial performance under your retained earnings, something that you need to know as well. Accumulated depreciation, this 5,000 at the end would then be brought down to the following year in the first day of the following year as a balance brought forward. It's always going to be credit balance, and this 5,000 will be reflected for the end of the year in the statement of financial position as the accumulated depreciation here. Okay, now let's look at what's happening the following year in 2019. The accumulated depreciation is charged again at the end of the year in 2019, and it's 5,000 there, right? We have this 5,000 accumulated depreciation also charged in here. Now the difference is between these two accounts is the depreciation account that is an expense account, its balance will then be 5,000 and not carrying forward from last year, because last year you already closed this account off to the profit and loss and brought it to the statement of financial performance. But accumulated depreciation is a balance sheet account. So balance sheet account, whatever balances that is from last year will always be brought forward to next year as a beginning balance, and then will accumulate, right? Will be impacted. Then this balance will be impacted by the current year's transactions, whether it's debit or credit. In this case, it's credit, and it will add up to the last year's balance, and the accumulated depreciation will go up to $10,000. Now this next thing is, like last year, you will close this off to profit and loss and zeroize it and bring it to your profit and loss for the 2019. And the accumulated depreciation, you will close it off and then would have a balance brought forward for the next year to close out this account properly. And this 10,000 would then be reflected in the statement of financial position in 2019 as the accumulated depreciation. Okay, so you got to remember this, because this output here is exactly what the examiner wants in a lot of questions that are dedicated to non-current assets only. All right, and I'll show you a bit of the trend on how frequent these questions are asked as well. All right, before we go on to that, O-level students, you have to understand what gain or loss on sale of non-current assets are. Basically, that is just the net proceeds from the sale, how much you get from the sale of your non-current asset, less your net book value at the time that you sell. Okay, give you a few examples. Let's try and understand it through that. If the motor vehicles from the previous slides that we are talking about, right, was sold for 41,000 on 1st of January, what is the gain or loss? Okay, so the previous slide told us, or let me go to the previous slide for a bit. Previous slide said that the net book value is 40,000 at the end of 2019. Okay, 40,000 here net book value, because the cost is 50,000, you depreciated it for 2 years, 10,000, and net book value is 50,000. So if the net proceeds is 41,000, then minus then that is 41,000 is the net proceeds, and net book value is 40,000, so the gain or loss must be $1,000. Okay, now what is this net proceed from sale? Why don't you just say proceeds from sale? Because sometimes when you sell something, there's a cost incurred to that, so you have to less off that cost as well. So if I tell you that, as part of the sale of your motor vehicle, there's a transfer ownership fee or ownership transfer fee that you have to pay, and that's 1,500, then how would that differ from the gain or loss computation? Try it out. Pause the video. I'm going to show you the answer now. Okay, so that's your net proceeds will be 41,000, which is what you got in terms of cash, right? And then you have to less off the fee that you have to pay to transfer this asset, and there will be a loss of $500 in this case. Okay, so that's all for gain or loss. Next one, very commonly they will ask you in exams to differentiate between capital and revenue expenditure. I've touched on this briefly, but I want to show you in a bit more detail how to differentiate these two. So cost is relatively high in capital expenditure. So think buildings, motor vehicles, all the big stuff, right? The revenue expenditure, think the low value item stuff, pens, pencils, for motor vehicles, maybe engine oil, those kind of stuff, right? Useful life, normally more than 1 year. This is less than 1 year. So if you have a pen, you probably write on it, and after 1 year, it's done, right? Petrol, if you pump it into your motor vehicle, after 1 week, depends on how much you travel, it's done, right? So think about that. Useful life of motor vehicle can last for more than 1 year for sure. Okay. Frequency of purchase. Should I put frequency of purchase here? That's what I meant. So in terms of frequency of purchase, capital expenditure would be those that you purchase, less frequently. Like you don't buy motor vehicles every day if you're not in the business of selling and buying motor vehicles, right? You don't buy a building every day if you're not in the business of buying and selling buildings. Revenue expenditures, on the other hand, would be things that you're likely to buy more frequently, and like if you pump petrol in your motor vehicle, it's going to be every week or something like that, right? Where it's reflected in the financial statements for capital expenditure, it's first parked in the balance sheet. So example, if you think about motor vehicles at cost, it's first parked in the balance sheet as cost of your fixed non-current assets, and then every year is depreciated through the income statement or the statement of financial performance. That's kind of how it's reflected, right? But for revenue expenditure, it goes straight into the income statement or statement of financial performance. That's it. Examples, motor vehicles cost, and this would include things like license, import duties, and stuff like that. It's not only the cost of the asset itself, it's whatever cost that needs to bring the asset to you, okay? And good for use, right? Other things like revenue expenditures would be expenditures that are recurring: petrol, maintenance fees, tax, insurance, road tax insurance, and stuff like that. Okay, so quiz. What is the impact to profits if, let's say, petrol cost was incorrectly posted to motor vehicles account? Think about it. It's a common question that will be asked. Okay, I'm going to show you the answer now. Profits will be overstated, right? Because if you take petrol cost and put it in a motor vehicle account, that means you are capitalizing it as an asset, and that goes into the statement of financial performance or the balance sheet, and the expense, which is petrol cost, that should be reflected in your other expenses in your statement of financial performance or income statement, will be lesser. So expense is inversely related to profits, and therefore profits would be higher than it should be. Okay, so these are the questions that I talked to you about earlier on, right? And we know straight line, we know reducing, we know the journal entries, we know the accounts, and we also covered profit and loss on sale. So we're mostly covered here. Now there are also in O levels, especially before these depreciation adjustments or additional information, there's usually something that tells you, you bought a new equipment for 4,000 and it's incorrectly posted to selling expense. So you need to make sure you correct for this error before charging depreciation to this item. You can't just take the depreciation, the cost of the equipment balance from the trial balance. You got to add this 4,000 before you hit the straight line method of 10% times the new cost of the asset, which includes this 4,000. Okay, here there are some theories that tell you reasons why depreciation are charged, etc. I've talked to you about that in the beginning of the slides. Go look at it if you still can't figure it out. But matching principle is one of them as well. Just a hint. Okay, I've put two links here to show you the exam trends from O levels and N levels and how often this topic is tested. So let's take a look at that. I'll click on N level first. So N level, I've done this thing, and I've got this in my videos under past exam trends, but I'll include this in the link for this video. Non-current assets capital expenditure is tested quite frequently alternate years, so be sure to know that this topic will be tested. And also this topic will be tested under balance sheet and income statement, which is your paper 2 question 1 question. Every year they will have a question on this, and depreciation is bound to come up, right? So that's for N level. Let's look at O level. O level, I'll click on this and see what happens. Okay. O level, same thing, right? Capital expenditure tested here once, non-current assets tested here quite often in 16 and 18, not tested last year, at least I didn't see it, and 20 not tested as well. I don't know whether it'll be tested in 21, but it's probably a good topic to know for O-level students as well. Balance sheet and income statement tested every year, so you'll be expected to know straight line and reducing balance method. Okay, so that's it. Thank you very much for your time. It's been enjoyable for me to do these videos, and if you like this video, hit a thumbs up and subscribe to get notification on new content if you haven't. Thank you so much. Take care for now.